Good morning, everybody. Mark, Solon and James Tully here from Symmetry Financial Management. This is the first of our webinars or podcasts with an update or briefing on what's been going on in the financial markets not only just for the last month, but for the last 12 to 18 months. But we're going to give you a snapshot and an overview of the activity and what's been going on and traction, etc. And then a couple of opinions on where we see it going, and a number of ideas in relation to investing in the short, medium and long term. Okay, so what we're going to cover this morning is we're going to give a little bit of information on the funds from the various companies, just show you what's been happening over the last 12 months, but last 3, 5, 7, 10, 15 plus years. Any of you that knows us will be aware of the fact that we're always banging the drum about thinking long term, trying to avoid the short term dips in the markets, and that plays out especially when you're a long term investor. I'm going to talk a little bit about cryptocurrency. We're getting asked quite a lot about it, and we would be favorable to an extent towards cryptocurrency. And in the last 6 to 9 months, particular investment fund managers have brought ETFs to the table, so exchange traded funds to the table, that retail investors can now access, the likes of Bitcoin and Ethereum. So I'll talk a little bit about that. Looking at financial markets, James is going to talk about what's going on there and drawing parallels with some uncorrelated assets, and then just basically follow up on next steps for those of you that are listening in. We will plan to repeat this every 4 weeks, so every month. And we're going to try and keep it to a 20-25 minute time frame. Okay, so just with regards to Symmetry, obviously a number of you will be familiar with us, obviously having dealt with us in the past. We started trading the Symmetry Financial in June 2018, so 3 years last month. Things have been absolutely flat out. We've been over we've exceeded all expectations, should we say. We've 8 staff now, and we're actively looking to hire more, believe it or not. So things have gone very, very well, and that's thanks in most part to our existing customer base and the referrals that we've received from you. So we appreciate that, and hopefully our service will back that up. We're based in Dunboyne, but we do have a national coverage, so we deal with clients in every corner of the country, and in fact we have clients abroad as well. Yeah. So in terms of the life company performance, just going to have a little look at the history in terms of the different in the funds provided by the different insurance companies and the different risk ratings associated with those funds. So we're looking at the lower risk category here, and again we're looking at the performance since 2014. So we're given a 7-year cycle here. Why are we using 2014? Because a lot of the multi-asset funds only became available after the previous financial crash. It didn't happen in 2010. A lot of the multi-asset funds only became mainstream in 2012, 2013, and indeed into 2014. So the likes of the MAPs, the MyFolios, the Prismas, the Prime, the iFunds from New Ireland, a lot of these funds didn't exist back at the previous financial crash. So that's why we're looking at it over that 7-year cycle. In terms of performance, again, you can see Irish Life miles ahead there in terms of their MAPS 3 performance. Standard Life MyFolio has done very well, and then at the bottom end you're looking at the likes of the Zurich Prisma 2, but while we're including that in a lower risk fund, in reality, you need to be looking at the Zurich Prisma 3 to compare it with the likes of the MAPS 3. However, we have put it in there because we do put quite a bit of corporate money into Prisma 2. So clients or companies that have money sitting on their balance sheet, not achieving anything, negative interest rates now coming into play from the likes of Bank of Ireland, AIB, etc. And that's only going to become more prevalent. Hasn't really impacted the retail client yet, but certainly for our corporate clients that have 7 figures sitting on their balance sheet, Prisma 2, as you can see there, in terms of its volatility, which is very, very low, but its performance will still outperform negative interest rates that have been levied by the banks. But low risk there is really for that type of an individual, but at least you can see the performance that has been provided over that 7-year period. And then when you're looking at what's called max drawdown, so max drawdown is in relation to how much risk the fund providers take and what the maximum positive and negative has been within that cycle. So if you're looking at, just pick the outliers there. So Standard Life MyFolio would have had a drawdown there of 13%. So that means it would have pulled back to the sum of 13%. Compare that with Prisma 2, where the max drawdown there is -4%. So, you know, if you're not comfortable with that type of a pullback in the 13 to 14% region, you're not really going to be comfortable with the likes of a MyFolio, even for your lower risk investments. But you'll always hear us talking about, when there's a pullback, it presents opportunity. It's not when you get fearful. When the pullback occurs is when you should actually get greedy. Okay, so that's the lower risk strategies. The higher risk, or sorry, the medium risk strategies. Then again, you can see now Prisma 4, the Zurich funds starting to come into their own. Again, any of our podcasts or webinars you'll have listened into before. Why do we like Zurich above all the other providers? If we just look at 2020 as a snapshot, Zurich were buying when everybody else was selling in the aftermath of the COVID pandemic taking effect in the financial markets. So you're talking April, May, June. A lot of the fund managers were actually looking to exit risky positions. Zurich were going, pardon the pun, but they were going balls out and buying up assets in that risk category. And even in their Prisma 4 fund, you can see that that's obviously helped, because the last 12 months in particular, they will have been ahead of their competition. So when you're looking then at overall max drawdowns, again, you're going to see double-digit drawdowns there. And then obviously in terms of the volatility is within the region it should be for a medium risk fund. So that's within a 5 to 10%, or even 5 to 7.5%, depending on which fund manager you're dealing with. But you can see that they are achieving what their goal is. Albeit the max drawdown, that will have been impacted by last year, being honest with you. So you're talking March 2020 max drawdowns on pretty much any fund that had any risk exposure whatsoever. But again, it's interesting to see how they perform compared with their counterparts across the board. What other fund would jump out there in terms of performance? Irish Life MAPS 4. And again, any of you that have money with Irish Life will be familiar with their dynamic share to cash model. Again, it's still very early. It's in its infancy as to how it's going to work out, but you can see that last year, obviously, they implemented dynamic share to cash because markets dropped by 25-30%, and obviously they would have went for cash with that percentage or that portion of their MAPS funds, and obviously it didn't do any harm in terms of their average performance over that 7-year period. Okay, and then when you're into the higher risk category, you are always going to be looking at the equity, the core equity funds, as opposed to the multi-asset funds. But again, what fund is miles ahead there is the International Equity Fund from Zurich. Again, and then the laggard funds will be Aviva. Aviva have had a torrid time in that space, and the MyFolio for Standard Life, they got a number of things wrong as a result of Brexit. With their focus, but they have turned it around and they are starting to play catch up. But you can see that the funds at the forefront there, the equity funds, the iFunds Equity, the International Equity Fund, and the Prisma 5, in fact, is actually up there, along with then the Standard Life, the Irish Life MAPS 5, and the New Ireland iFunds 5. Okay, so that's the chunkier end of the portfolio. Okay. Again, when you're looking at the max drawdown, actually didn't come through there. Apologies for that. I'm not sure why, but you can see that the volatility has been achieved. So we'll have to rectify that for the next presentation. But you would see there, in terms of max drawdown, you're going to see 15 to 25% drawdown, depending on which fund at which particular time. And again, obviously March 2020 is going to be the outlier time frame there. Okay, so that's just a snapshot of what's going on. You can see all the insurance companies, in terms of their multi-asset funds and in terms of their equity funds, have performed absolutely to most people's satisfaction. So hopefully those of you that are listening in have taken exposure, maybe not necessarily to the core equity funds, hopefully with a small percentage of your portfolio, but certainly with the multi-asset funds, you shouldn't be seeing negative territory with any of your investments, even if you happened to invest at the most recent high, which would have been February 2020. You're now well in excess of what the value would have been in February 2020. It is something, though, that you would need to be mindful of. we would still be bullish in terms of performance going forward, but you will have to expect, and we will have to see some form of pullback. It hasn't happened yet, and I do underline the word yet, but we would have to anticipate that there should be some form of pullback in the foreseeable future, and James might touch on that. Okay, so in terms of cryptocurrency, again, that headline, it popped back above 39,000. Cryptocurrency, that would be Bitcoin, of course. Cryptocurrency is an extremely volatile asset class. There isn't any risk rating that covers cryptocurrency other than it's off the charts in terms of its volatility. So what does that mean for a client? It means you need to be comfortable with high highs and low lows. So if an investment can go from let's just say 100, and it can drop from 100 to 40, and it can do that extremely quickly, you need to be comfortable with that drop from 100 to 40. But equally so, it can go from 100 to 1,000. Okay, and that is the attraction of cryptocurrency as an asset class, and it has now been defined and designated as an asset class. It's in the news all the time in relation to China banning mining. All that's happening there, you don't hear in the news that then it moves to another country. So other countries have now opened up to cryptocurrency mining, Bitcoin mining, in specifically. There's also the whole concept of ESG and the impact of mining on the environment, and whether or not it's been funded by solar energy, wind energy, or burning of coal, which is what got Elon Musk and Tesla into a little bit of difficulty with a number of his larger shareholders. But when you read underneath the hood, all that's really happening is it's found a bottom, and that bottom seems to be in and around the $32,000 per coin. And when it hits that level, it seems to find a lot of support. And what that means is buying. So institutional investors have now entered this market. There's large fund managers and large investment firms with providing a focus now on cryptocurrency. If some of these ETFs were to get regulation in North America for pension investing, then it's game over in terms of where these assets are going to finish up. You'll read anything from $20,000 a coin for Bitcoin up as high as $1 million a coin for Bitcoin. That's a wide spectrum. That's a wide range. Obviously, there'll be time frames involved in there. Our opinion to clients our opinion to our clients is, if you do want exposure to cryptocurrency and it's purely with cash, open up an account with one of the larger providers, the likes of a crypto.com or a Binance or a Coinbase, and dollar cost average, which I'll cover at the end, into the assets and pick the core ones. There are over 3,000 currencies or coins available. Pick the core ones, the Ethereums, the Bitcoins, the Aves, the Litecoins, and there's another few there that we could talk to you about on another time. But focus in on the larger market cap coins and purchase those on an averaging basis. And should you be disappointed in the next 5 years, I would suggest that you won't. Okay, so that's just a snapshot in relation to the currencies or the cryptocurrencies. ETFs are available via your self-administered pension funds, and Aviva have brought 2 ETFs, Bitcoin and Ethereum ETF, to the market through what's called their self-direct investment option, which is available for ARF clients, is available for PRBs, personal retirement bonds, and is available for executive pensions. Minimum investment level there, James might correct me, I think it's 15,000. Is that correct, James?
Yes, that's correct, yeah.
15,000, there we go. So it's not a huge amount of money. So if you have an ARF worth 150,000 or more, 15,000 euros exposed to a Bitcoin or an Ethereum ETF wouldn't necessarily be a bad thing. The problem is you can't dollar cost average or euro cost average into these ETFs. There will be a minimum exposure of, because it's a trade. So you are actually executing a trade into one of those funds, and hence where that minimum cap or minimum investment cap comes into play. Okay. So with that in mind, I'm going to hand it over to James, and he's going to just give you an update on what's happened in the markets up to the end of June.
So thanks for that, Mark. And Mark will be my prompter here as I tell him to move the slides along. But yeah, I'm just going to be talking about events that have kind of happened in the markets. So I suppose, Mark, if you just move on to, yeah, that's perfect. So what we're seeing here is basically, it kind of looks a bit of a complex chart, but it's really just breadth of the market. So that is the S&P 500. And you can actually see the S&P 500, the index, making new highs. But the actual amount of companies within that 500 index are not really confirming it, you know? So it's kind of showing you that it's possibility for a pullback. If you can kind of see here where the blue line kind of tilts down, uh, in the past, it's kind of shown as a bit of an indicator that the market has gone a bit frothy and it's kind of due for a pullback. You know, if you really want to see a strong market, you want to see the index make new highs along with all the different companies.
Okay. So
So if
just
you move,
Yeah, so that's so again, just to kind of summarize what James is explaining here, the obviously the top chart here is the S&P 500 historic performance. I think we have 3 years on that, James, don't we? And this
yeah,
is the top 20 companies within the S&P. This is the top 50, and this is the top 200. So just to summarize it, the top 20 companies over the last 3 months have actually seen a pullback. The top 50 have seen a pullback, and the top 200 small slight pullback, so
yeah,
slightly flat. So what that's suggesting is that the core elements of the S&P 500, which is, for those of you that aren't aware of it, it's the largest index in the financial markets. It's referred to as the heartbeat of the financial markets, and it drives the performance across the board. If the S&P pulls back, everything else pulls back. Okay,
that's
so
correct. Yeah.
within that, the core components, the 20 top companies, the 50 top companies, the 200 top companies haven't been performing that strongly over the past quarter. We'll see what happens going into July or at the end of this month, but that can be an indication of a pullback, as James has highlighted here back in 2018, and obviously here in 2020, which was the Black Swan event, which was an outlier event no matter what. Okay, so
Mm.
just a snapshot and something to bear in mind. Okay, on ahead.
Yeah, so this is massive, and it's probably not talked about enough, to definitely to retail investors or new investors. But yeah, as it says, it is the biggest input for financial markets. It is the central bank balance sheets. So you can see here, it's the Fed, so that's the U.S. central bank, ECB for Europe, and Bank of Japan for Japan. And I mean, the correlation is so high, and this kind of really started happening after 2008. You know, um, the more liquidity there is in the market, the easier things get for financial markets. And you know, if you look back even at 2020, the bottom was really signaled by the couple of trillion that the Fed, you know, pumped in. So I mean, that's the one to follow. When that starts to decrease, you know, you can kind of take guys where the market might go.
So if we hear again, what's the takeaway there? If we hear that the Fed or the ECB or the Bank of Japan or any of the large central banks are pulling back on their quantitative easing policies, that would be a negative signal for the markets. Okay,
Mm,
so keep printing if you want the markets to go up. Whether you
yes.
agree with the philosophy or the this new money, modern monetary theory, whether you agree with it or not, don't bet against the Fed. I think it's not
Exactly.
that's a good advice. Yeah. Okay. So this was an interesting one, James.
Yeah, so I mean, we've seen this across the commodity space, but in particular, this is the price of lumber, um, absolutely skyrocketed. Um, so, you know, when you look at coronavirus, there's a huge amount of shutdowns across mines. In this case, it was sawmills. Um, and when they're shut down, it's, you know, it's not as easy as just turning them back on. So again, if you look at any of the broad commodity indexes, they're up at, you know, massive highs. They've had a great, you know, 12, 16 months, um, just on the basis that demand, pent up demand, and then supply chain issues. So, you know, if you look in America, the vast majority of the houses are built with lumber, with, you know, wood. So there's just not enough houses in America. I think that's a global thing. So the demand for the wood is huge, and the sawmills were turned off. So you've seen just a huge increase in price. Speculators, obviously, as always, will get in and exacerbate things. Um, but you can actually see it now pulling back, and a lot of the commodity space has pulled back. If you look at even copper and things like that, you know.
Mm.
Um, And yeah, so a big part of what I've been the slides I'll be covering is kind of to do with inflation. So inflation really just comes from commodity prices. And then the next couple of slides will kind of also be maybe on the longer train of thought. So you can see here the world inflation rate, and then you can look at the population increase. So so basically they're both trending down. So it's quite a simple formula. The more people, the more demand, the more inflation. And then the second one, another big factor is debt. And debt really does over the long run crush uh, crush growth. You can see it trending down. And it's not just a soul thing. It's often said that it's the population and debt. Those are secular trends which will continue. So will we see growth continue to decline? It's a possibility.
Okay, very good. Do you want to talk a little bit about investment goals then?
Well, yeah. So, I mean, it's the space that I've been covering, and it's just getting people started. The stuff that me and Mark cover, which the dollar cost or the euro cost averaging is so important. And asset prices, they are up very high, but you could have said that for the last couple of years. But you're really being penalized at the minute, being in cash. It's just it just doesn't seem to be working. And in my view, I think how it's just going to continue. Asset prices are just probably going to continue to rise. Obviously, there's going to be ups and downs, but you definitely get invested. Would be my word of
Yeah.
advice.
Yeah, so again, absolutely. And again, those of you that have engaged with us over the last 12 months, James came on board from an investment perspective to help me with existing clients and new clients going forward. He's got a wealth of experience, and it will come across in the future webinars as well when we pick particular topics. But very much it's about planning what you want to do in terms of timeframes, investment goals, and then it's the ongoing communication piece, which is what this is about. So we have been lacking in that space, and I'm holding my hand up on that front, absolutely. But that's been corrected. That has been corrected with James coming on board, and between the two of us, we'll be the face of the investment space going forward. So do feel free to reach out to us and monitor your investments, because there are some interesting things going on out there. There are some uncorrelated investment opportunities as well. James touched on commodities there, which is, again, we would talk a lot about commodities because of the correlation and not a non-correlation with some of the core assets. So depending on what particular asset you're picking at. We picked lumber this morning because it's not something you will ever hear about, but it is that little hidden secret. And in particular, talking about building new homes, which is an issue facing the current generation in Ireland with the lack of new developments ongoing, but the costs or the hidden costs associated with that now for the developers getting access to lumber, getting access to material. Obviously, the lockdowns didn't help with the shortage of supply and delays and timeframes, etc. And those of you that are building a new home or are on a waiting list to buy a new home, you'll be very familiar with what we're talking about there. Okay. In terms of portfolio growth, really what we're talking about here, just before we wrap it up, is the averaging effect. So this isn't necessarily going to be available for everybody, but just that, if you're coming with a lump sum at retirement, so you're retiring and you've got a 500,000 in a pension pot or 200,000 in your pension pot, you're faced with investing that money at that particular time frame. So you're buying the units on day one. Okay. Now, some of the insurance companies, if you are going down the insurance route, will allow you to invest that money on the drip over a 12-month calendar period. So if you have, just to put that into context, if you had 120,000 euros, using a simple example, some of the insurance companies would allow you to buy into their unit-linked funds at 1/12th. So 10,000 in January, 10,000 in February, March, April, May, June, July, August, September, etc., up until the end of the year. So by taking that approach, you would have invested your 120,000 euros over the 12-month period. And that is in the single premium or the lump sum investment space. For those of you that aren't in that category, where you're literally in your 20s, 30s, or 40s, or 50s, and you're in the accumulation phase, that is where the unit price averaging or dollar cost averaging works to your advantage, because the price fluctuates up and down. And what you're doing by taking advantage of buying on the drip is you're buying units when prices are up and you're buying units when prices drop. And what it basically does is it has an averaging effect. Now, it doesn't always work, but over time, what it allows you to do, or what it should allow you to do, if it's explained to you properly, is it should allow you to take more risk. Because when you know that the volatility is your friend and you understand that, then you're able to say, okay, I'm not a high risk investor, but I do understand that if I'm saving for the next 10 years and I'm saving €1,000 a month, by taking more risk gives me access, or potential access to more volatility. And volatility, believe it or not, guys, is what you're chasing. Okay. It is a little bit different when you're investing that lump sum. We do bear that in mind. And any of our larger value clients, we would have much more of a hand-holding approach with you. We're available on pretty much on a daily, weekly, monthly basis as is required by you. But for the regular premium or smaller investment client, we would suggest that you look at or consider that averaging approach. Okay, so the benefits obviously is everything what I've explained. The main thing is it should allow you to take that higher risk, and it's taking that short-term mindset out of the equation. Okay, so the problem most people have with investing is emotion. So they become emotionally involved, and that is what makes you make the wrong decision. So if you can take emotion out of it, then hopefully you're going to be driven by making the right decision. Okay. So from our point of view, what would we recommend you do? If you're not already engaged with us, reach out to us, have a chat with myself, have a chat with James. Let's see what your goals are. Let's see what your timeframes are. Look for the advice. There's loads of stuff on YouTube. There's loads of companies out there providing you with the information as well, and we're obviously aware of that. Just be aware of any particular what would you call it, conflicts of interest. So I mean, we don't have that conflict of interest. Our initial consultation and all of our initial meetings with clients are complimentary. So what that basically means is you get half an hour, 45 minutes with us, no charge. Basically it's a data capture for us to find out if you're suitable for us as much as if we're suitable for you, to be honest with you. And if there is a match there, then we'll put a plan in place, and whether that plan involves us charging you a fee or us being paid a commission or a referral or a rebate by the provider, that will all be explained up front. If anything, we go overboard in explaining charges and fees, which means you're going to ask us extra questions, but that's the approach we take. So do feel free to reach out to us. And that's it for this morning's first webinar. So we'll put the recording up there for those of you that haven't been able to attend live. And if you do want to follow up, again, reach out to myself or James, and we'd be very happy to help. James, anything else you'd like to add?
Yeah, all of the above, but take action would be the big one, and you'll thank yourself in 10, 15 years time.
Correct. Okay, guys, thanks a million for logging on, and thanks a million for joining us, and we'll talk to you all soon.